Block stock is down over 20% after reporting a very disappointing earnings report. Block reported an earnings per share of 56 cents and reported revenue of $5.77 billion versus $6.2 billion expected by analysts, missing their revenue estimates by almost $500 million. The company also had a very weak guidance for the second quarter and full year, where they expect $2.45 billion in gross profit in the second quarter and only $9.96 billion in the full year, while analysts were expecting a $2.54 billion of gross profit in the second quarter and over $10.2 billion for the full year. Block also said that there is a very weak macroeconomic environment that they are facing, and this reflects for them lowering their guidance for the full year. But what does Block actually do? Block provides tools and services to help businesses and individuals access and participate in the global economy. They offer products such as Square, which is for businesses that allow transactions to occur. They also offer loans to businesses, and they also own Cash App that allows people to send and receive money to others online. With this, I'm going to use my 7-step stock analysis in order to look at 7 key metrics that I find are the best to look at. To first look at the company's financial health, and later in this video, I'm going to be analyzing Block stock and determining the intrinsic value I believe we should buy it at. So the first metric that I like to look at is the trailing PE ratio, which is the price of the stock divided by the earnings per share, and I want this to be greater than 0. If this is greater than 0, that means that Block is a profitable company, and as we can see here, they have a trailing PE ratio of 12.82, so that is a very good check mark and looks pretty low at a very low valuation. Because the S&P 500 trades at about a 20 PE ratio, this is almost half the valuation the stock market trades at, so that looks pretty good. Similar to the trailing PE ratio, we have the forward PE ratio, which is almost the same as the price divided by the earnings per share. However, this is the price of the current day stock price divided by the earnings per share in the future, in which analysts expect them to have. So I want this to be less than 30, showing that in the future, they expect them to trade at a decently reasonable price. And as we see here, there's a 13.39 forward PE ratio. So that is pretty good for Block. However, it is only a little bit worrisome that the trailing PE ratio is lower than the forward PE ratio. This probably means that the earnings per share that analysts expect in the future is less than what it is today. But nonetheless, this is still good and is less than 30. Now we're going to take a look at the revenue growth rate and the earnings growth rate of Block. And I want this to be greater than 5%, showing that the company is growing at a pretty decent rate. And the only reason a stock really goes up is because of the earnings also going up. As we can see here with the revenue growth, we can see that in 2015, they had about a $1 billion revenue per year. And as we can see, as of today, it's at $24 billion. So this is easily greater than our 5% revenue growth rate. This is very great growth. But as we can see, it's been slowing down slightly, but still, this is very fast growth, and that's a check. Now, if we take a look at the earnings growth rate, we can see for Block that it was very stagnant and negative basically till 2020. But in 2020, we saw a huge increase in the earnings, and then 2022, we saw a big decrease in earnings. And now we can see huge earnings growth from Block. So I'm going to give this a check mark just because of this huge growth. We need to see Block hopefully sustain this earnings growth rate, because the only problem with this I see is that their earnings growth rate is not consistent at all, and I like investing in companies that have consistent growth rates. But nonetheless, this is still greater than 5%. Now I'm going to take a look at the shares outstanding of Block. And I want them to be buying back shares, meaning the shares outstanding decrease over time. Because if the company buys back shares, especially at good prices, that means us shareholders will have more of the company, since there's less shares for other people to purchase. And as we can see here, Block has been increasing their shares pretty rapidly, which is not good for us and means they're diluting us shareholders, in which we'll own less of the company if we held it over time. We can see it's gone from 464 million to 619 million shares outstanding. So that's not good for us investors, so that is an X for Block. The next metric that I like to look at is the total debt divided by the equity. I want this to be less than 50%, which means that the company will have double the amount of equity compared to their debt. So if they have twice as much or greater of the amount of equity than their debt, that means it is pretty unlikely for them to go bankrupt, and they have a pretty good balance sheet. As we can see here, they have a 26.72% total debt to equity ratio, which is a check mark and shows a pretty decent balance sheet for Block. Now, the final metric that I'm going to look at is the analyst expectations for earnings per share growth rate in the next 5 years. I want this to be greater than 5%, just like the revenue growth rate and earnings per share over the past 10 years. I want this to be greater than 5% to show great growth, and that overall the company is going to be growing over time. And as we can see here, analysts expect a 26.4% growth rate over the next 5 years. So that is insane growth rate that they're expecting for Block. So that is also a very good check mark, and if they can actually grow that fast, this company looks pretty good to purchase. Now, the final thing that I'm going to do is analyze Block stock using my intrinsic value calculator. With using this, I have to have assumptions of the future over the next 10 years to determine the price that I would be willing to pay today for Block stock. And the first thing I have to predict is the revenue growth rate over the next 10 years. So I'm going to go over to here and look at what analysts expect Block to grow at. And they expect them to grow at about an 8.3% rate for the revenue growth rate. So if I go back over here, I'm going to put about an 8% revenue growth rate for Block. I think that's pretty reasonable. Now at the net profit margin, we can see that the net profit margin for Block's been about 12%, so I'm going to leave that at 12%. Now for the cash conversion rate, I can leave that right there. And for the PE ratio, for Block, I'm thinking a PE ratio of about 17 is pretty reasonable, just because I think the revenue growth rate is slightly higher than the stock market, and I believe they should trade about where the stock market is, also because they're in a pretty heavily competitive industry, so I believe they should trade at about a slight discount compared to the stock market. Now for the discount rate, I'm going to put 15%. I want a great margin of safety in order for us to purchase this company. And with these assumptions, I get a fair value price of $74 per share. However, right now, the current price isn't at what it is right now with the 20% drop. So I believe if you bought this today, you could probably make about a 20% return. Only if you believe these assumptions, however. I would not personally invest in this company. I've had this company on my radar. However, I believe the company is slightly too inconsistent for me to invest as of today. However, maybe in the next few years, I would look into this company more. But the earnings per share is just too inconsistent for me. And I also believe this space is way too competitive, and they just don't have a huge competitive advantage over other companies. So that's why I personally wouldn't invest in the company. However, with these assumptions, if they do come true, this would be a pretty good investment as of today. So if you guys like this video, please subscribe, hit the like button, and thank you for watching.